So without wasting any more time, thank you to everyone who has joined us this morning. My name is Yolanda Oguma, and I'm the head of events and marketing at the Delegation of German Industry and Commerce in Nigeria. First, one of the speakers, firstly, I'll be introducing Mr. Theophilus Emuwa, who is a partner at Aelex. Mr. Emuwa, if you don't mind, please give us a brief background about yourself and your company, and why we're here today.
Okay, well, I think why we're here today is because of the topic. I'm a lawyer with Aelex. Aelex is a full-service law firm, so we provide services in different practice areas, science and industries. I'm qualified in a number of jurisdictions, starting with the UK, where I was admitted to the English bar, and then I got admitted in Nigeria, and then I also got admitted in Ghana. So we actually have an office in Ghana as well as 3 offices in Nigeria. So we practice within the region. Taxes is a subject that's been dear to my heart for a long time, well before the tax authorities started getting quite proactive. So it's only now that I'm beginning to enjoy the fruits of my investment in learning and understanding tax. So today we'll be speaking about what this new Finance Act does to businesses, and I hope it will be an entertaining and interesting conversation. Thank you.
Thank you very much for keeping it very short. Mr. Ajibola Olomola is also here with us. He is a partner at KPMG Nigeria. Mr. Ajibola, please tell us a bit about yourself and the organization you work for.
Good morning, Yolanda, and good morning to all the participants. My name is Ajibola Olomola. I am a partner with KPMG. By way of background, I'm a lawyer, much like Theo. I'm also a chartered accountant and a chartered tax practitioner and a member of the Institute of Chartered Arbitrators. My role at KPMG is to supervise the international tax business and mergers and acquisitions business, where I also play a role as the head for deal advisory across Africa for KPMG. In my role as a tax partner at KPMG, I have also provided advice and support, not only to the Federal Inland Revenue Service, but also the Minister for Finance and the government of Nigeria in the fifth space, in providing support in the promulgation of the Finance Acts and other legislation affecting tax and fiscal matters in Nigeria. It's a pleasure for me to be here, and I look forward to an enterprising discussion. Thank you, Yolanda.
Thank you very much. Oh my God, I feel like we are in fantastic hands today. But without wasting much time, Kat has finally been able to join us successfully. And I would just like to give her a few minutes to give us a welcome, to talk a bit about the delegation and how we support businesses in Nigeria. So Kat.
Thank you very much, and good morning, everybody, also from my side. For the hiccup, as Yolanda said, Happy New Year. There is no webinar where there won't be any surprises. But I also want to repeat what Yolanda just said. We're in really good company today with the speakers who have just briefly introduced themselves, with Yolanda, of course, and then with all the participants that are on the line. We're somewhat overwhelmed. This is the first webinar we're organizing this year, and we seem to really have picked the right topic with the right experts to be able to provide information that is relevant to you and that is hopefully helpful as you continue to grow your businesses this year, despite the overall and very interesting times that we're working in. So my name is short for Katharina Felgenhauer. I'm the delegate of German Industry and Commerce here in Nigeria. And the Delegation of German Industry and Commerce in Nigeria works to promote German-Nigerian business relations. So our mandate is to support German companies in Nigeria and those that want to do business with Nigerian partners, but also to support Nigerian companies that are interested in German partners, German products, or doing business with or in Germany. And even beyond, we are trying to promote or to support companies basically wherever they are, because for German investors and our German companies, it's very important that the market, in this case Nigeria, is attractive, gives opportunities. So whatever we can do to support business and to make sure that information about market information opportunities is shared, that is where we become active. So this is where this webinar today fits in. We will discuss the Finance Act 2020, a very timely topic, as it has just been signed off by President just of a Christmas gift. Whether that shared by speakers and also our participants. But just to also frame it in the context of our work as Delegation of German Industry and Commerce in Nigeria, you know that we work in certain sectors, more specifically where we have dedicated so-called competence centers that look at business opportunities in agribusiness, in innovation and startups, in this whole ecosystem, in energy and environment. We're looking at market entry in other industries as well through our service center market entry. We provide services in marketing and communication, where Yolanda is the first person to talk to. And we have a long-standing initiative in the area of dual vocational training through our competence center skills development. None of those competence and service centers would be working without looking at the legal environment and also the conditions for doing business in Nigeria. So the Finance Act 2020 cuts across all our topics and affects all our partners and clients. So no better time than to discuss this here today. I want to particularly acknowledge the support, the sponsorship by Aelex, also long-standing partner of ours, and also recognize the contribution by KPMG. As you know, our two speakers today, our lead speakers, are from these two companies. So thank you very much for joining us today. We're really looking forward, and we're also looking forward to a lively discussion with all our participants. So please enjoy. I'm very happy to see you, and I'm really, really looking forward to this session.
Thank you very much, Kat. I think that we can get right into business. But before that, I just want to mention that if you have any questions, please use the Q&A function. We will start with the presentation first from both speakers. And then during the course of that, you can drop your questions. Afterwards, we would address them. I already see someone using the Q&A box. There's already a question there, but this will be addressed after the presentation. So leave as many questions as possible, and we will try to address everything on time. And if there's need, we would contact you maybe personally to provide more information. So Mr. Emuwa will be going with the first presentation. And so I'll just hand over the floor to him. Thank you very much.
Thank you, Yolanda. Thank you, Katharina. I'm glad to be here. Let me just put up my, there we are. So good morning all. We're looking today at the Finance Act 2020, which, as Katharina said, was signed only a few weeks ago. What the Finance Act does is to make amendments to various primary or principal pieces of legislation. So it makes amendments to the Companies Income Tax Act, the Personal Income Tax Act, the VAT Act, and a number of others. So we'll be looking at the amendments which have been introduced by the Finance Act to these other principal pieces of legislation. The first one will be looking.
Mr. Emuwa, sorry, before you go on, if it's possible to speak a bit more into your speaker because you're a bit low. Yes.
Okay.
Fantastic.
I'll try.
Thank you.
Okay. So I was saying that the Finance Act makes amendments to various principal pieces of legislation. The first one we'll be looking at is the Companies Income Tax Act, which the Finance Act has amended in a number of areas. The first area has to do with the exemption on interest on loans. So if a bank gives a loan to a company that is in certain industries, the interest which the bank receives is exempted from tax in order to encourage banks to lend to those sorts of industries. So one of those industries is agriculture. And what has been done is that previous legislation gave the exemption where the bank lends to agricultural trade or business. What the Act has now done is to change this definition and say it is only when you lend to primary agricultural production that this exemption will be enjoyed. In other words, if you're in intermediate or processing of the agricultural produce, you no longer will enjoy this benefit. So they've limited or reduced the scope of application of this exemption. So for those people who are in agriculture, this is something to take note of. On the flip side, they have provided some generosity by saying that if in the previous case, a moratorium of 18 months minimum was required for the bank or lender to enjoy this exemption. Now the moratorium has been reduced to 12 months. So if you have a 12-month moratorium, the lender can still enjoy the exemption. Taxation of non-resident companies is another issue, some item that has been, shall I say, a bit controversial in the last few years. In last year's Finance Act, something new was introduced, which had to do with, a concept called significant economic presence. My friend Ajibola will speak a little bit more about this, but one of the issues that has arisen is how do you tax those entities which are now caught by that provision? What the new act has done is to amend the Income Tax Act to say, okay, for certain non-resident entities, once they pay a withholding tax of so much, we won't bother asking them to file returns and get assessed for tax. So from an administrative point of view, it makes life easier for the taxman. So the tax is deducted by the payer who has enjoyed the service and remitted to the taxman, and that's the end of the matter. Another controversial area has to do with shipping and air transport. Now, as you will understand or appreciate, if an airline carries passengers from outside Nigeria into Nigeria, the question is that income, should it be taxed in Nigeria or outside Nigeria? So the rules tend to be that if you carry people into Nigeria, you tax where you started your journey. If you carry people out of Nigeria, you pay tax where you started at in Nigeria. Same thing with shipping. When cargo is brought into Nigeria, that income should be taxed at the point where the journey started. If you're carrying cargo from Nigeria, then that income is taxed in Nigeria. But an item which has been controversial is when a shipping line brings in a container of goods, unlike at airports where you pick up your bag and you leave the airport immediately, the container is given to the consignee to take away because he can't offload at the ports. He keeps the container for a few days or weeks, takes his goods out, and then returns the container to the shipping line. In many cases, the container is not returned, it's lost, and he has to pay compensation for that loss. The question is that receipt taxable in Nigeria or outside Nigeria? It's a matter that hasn't been resolved. The tax people, the tax authorities take one view, the taxpayers, that is the shipping lines, take a different view. It has gone to litigation. The tax appeal tribunals has looked at it and come to a view, and litigation is still not ended because the losing side is not happy. Now the current Finance Act has sought to remove that controversy by saying when it is non-freight income, it will not be taxed outside, it will be taxed in Nigeria. I will press my friend Ajibola to tell us whether he thinks this has removed that controversy completely, but I still think that there is still some area of ambiguity, and there'll still be room for debate amongst the taxpayer and the tax authorities. A Christmas gift, as Katrina called it, is the next one. The minimum tax rate for insurance companies was reduced just for 2020 and 2021, from 0.5 to 0.25. Same thing for companies which are loss-making. There was a minimum tax which they are to pay, and that has also been reduced, but only for this 2020 and 2021. So while it's a gift, It's a gift which has an expiry date. Another gift is that if you made donations and contributions in respect of the COVID pandemic of the last 1 year, you're now allowed to deduct those donations as an expense of your business, but only up to 10%. And this incentive is available for other types of donations which relate to any pandemic. It's not limited to COVID, but right now the main one we're looking at is COVID. So I suppose if you were to donate money for things like Lassa fever that is prevalent in Nigeria and things like that, you should enjoy this deductibility. Gas utilization. Again, companies which are involved in downstream gas utilization projects have a number of incentives which they've enjoyed over the years. In some cases, because the companies are also involved in upstream, that is, they explore, produce and produce crude oil, they were allowed to take an incentive at one end and take a similar incentive or exemption upstairs against their crude oil. What this provision is now saying is if you take it in one place, you can't take it in the other. In other words, once you've enjoyed it under the Companies Income Tax Act, you're not meant to enjoy it under PPTA. Again, things that over time we'll see how that plays out. Unpaid tax, when does penalty and interest start running from? Another point of controversy. Previous legislation seemed to suggest that until you have resolved the objection with the taxman, so if you disagree with the taxman on the assessment, until that is resolved, your liability to pay has not arisen, and so the penalty and interest does not begin to run. This amendment is trying to is proposing that from now on, if you lose, then the penalty and interest should run from the time when the tax was initially meant to be paid. So in other words, you can't get a benefit simply by drawing things out, delaying payment, and ending up losing. If you've lost, then it means you should not have fought in the first place. So it's to create a disincentive for frivolous objections. Foreign companies with Nigerian operations and Nigerian income are required to file tax returns. This is something that's been going on for a while. The FRS issued a circular some time ago. Now it has been embedded in legislation. But in addition, they must also produce the audited financial statement of the foreign company, which is an addition which helps the taxman in Nigeria to see whether the allocation of income, profits, costs, and expenses is fair, because they want a situation where the operation in Nigeria appears to be loss-making, and there has been some profit shifting which has gone outward into the parent company. Gross turnover, there's a definition of it which has been amended. I won't go into it. It's a bit technical, but perhaps Jibola will provide some elucidation on that. Qualifying capital expenditure. Before now, software and electronic applications did not appear to qualify for capital expenditure. This has now been clarified, and now you can claim for those sorts of expenditures. Personal income tax, that's another area where there's been an amendment. The first amendment I'm going to draw attention to has to do with the significant economic presence concept. Last year it was introduced, but it was limited to companies. Now it's being extended to natural persons. What this says is that if you're a foreigner providing services to Nigerians digitally or by other means, but from outside Nigeria, you will be caught, or you could be caught by Nigerian taxation. So the fact that you are not resident in Nigeria, you never entered Nigeria, does not mean that you will not be caught by Nigerian taxation. So if you provide service by email, so this would tend to apply to professionals, for example, engineering consultants, lawyers abroad, people like that who provide services to Nigerian entities. They will have to think about how they're providing those services and whether they're in fact caught by this provision and are therefore liable to pay tax on the income they're receiving from the client in Nigeria. Luckily, one might say the tax will just be a one-time tax of withholding tax. You may not have to, render accounts and all that. You might say that's a lucky thing, but somebody else might say, well, if I don't want to have to pay the tax at all, so I'm not lucky. But that's the position with that. So for professionals and people like that, it's something to think about. An item that has been removed, which is a historical legacy, had to do with commencement and cessation rules. The way you account for your profits in the early years could sometimes lead to the profits for a period being taxed more than once. This has been, removed, and so things are more straightforward, and you will pay tax year by year. Although many companies did not have a problem with it, it only became relevant if you were profitable from your year 1 or year 2. But if you were not making profits in the early years, as most businesses, would do, it wasn't really an issue. Gross income has been, tidied up. Before now, if you had income from, say, treasury bills, which were meant to be exempt from tax, and you included this in your total income, your total income would get taxed, even though some elements of it should not have been taxed. And this was a source of controversy because the taxman was saying, well, it's your income, and I'm looking at your total income. So it's been clarified now that if you have those elements that are supposed to be tax exempt, you can separate them from your total before rendering account returns and paying tax on the remainder. Another item that you can deduct is life insurance premium payments, and now it's now clear that those can go out, and deferred annuity payments can also be excluded. VAT, last year the rate went up to 7.5, but there was some controversy which last year the government tried to clarify, which had to do with the definition of place of supply and time of supply. They've made a number of amendments to what was done last year to make it even clearer. The question is, has that clarity been accomplished? I will, prod my friend Jibola later on to look at this and tell us whether, we'll have that discussion as to whether this has indeed been made clear enough. There's some areas where I think there's still some room for ambiguity. And this is one of the areas where the taxman would have a view, and unless you're prepared to challenge that view in court, you may have to accept the taxman's interpretation of the legislation. Time of supply, yes, another controversial item. If I supply a service or supply goods, but I don't get paid for a month or two, which is not uncommon with professionals like us. As a lawyer, I'll provide a service, I'll send my invoice today, and the client may not pay me for 2 or 3 months. What the taxman is saying is that the VAT on that invoice should be paid immediately. Once I've issued the invoice, I must pay the VAT, even though I've not received the cash. Now, this is going to create a problem for people in those sorts of businesses where payment is not immediate. If you are a shopkeeper where you get paid as soon as the person is walking out of your shop with the bag of sugar or the packet of milk that he bought, that's fine. But for professionals who render an invoice and wait to get paid, it's going to create a cash flow problem. But I suppose the taxman is saying, well, I shouldn't have the cash flow problem. You make sure that your clients pay you on time. So how this will play out over time, we were yet to see. But on the flip side, the law has now recognized that sometimes you may provide a service in installments or provide goods in installments, and what it is saying is that each installment will be treated separately as a separate supply. So in this case, it is only the VAT for that installment that we shall be looking for. So if you're to supply 10 items a month for the next 12 months. And that's what the contract says. We won't ask for VAT for the 12 months supply, we'll ask for VAT for each month, which is a good thing. There's an amendment which appears to have removed something which was introduced many years ago, where you provide services to the oil and gas industry. There was to be the oil company was entitled to deduct VAT at source. Instead of paying the VAT over to you for you to remit to the taxman, the oil company was entitled to hold back that VAT and send it to the taxman directly. In the course of this Finance Act, the amendments in this Finance Act, that provision appears to have fallen out. I don't know if that was deliberate or not. We might hear more about that later on. Christmas gifts, again, exempted goods have been expanded to include commercial aircraft engines and their spare parts. So if you import commercial aircraft or engines and spare parts, VAT is exempted. Exempted services, another gift. Airline tickets, are no longer subject to VAT. So if you buy your ticket from any of the local airlines, Arik, Air Peace, Asman, whoever, there should no longer be a VAT element. Capital gains tax, where you sell an asset and you make a gain on the sale of that asset, there's tax to be paid on the gain. The rate of tax is different from the rate of tax you pay for companies' income tax or personal income tax. And so sometimes a taxpayer would prefer to treat an item, a transaction, as a capital transaction, and therefore the receipt is a capital receipt, which is subject to CGT. There's now an explicit obligation to file returns. Before, it wasn't so clear, and many people did not bother filing returns, and the taxman did not go after them. Now it is clear that you must file. So if you fail to file and they catch up with you eventually, yes, you might have to pay, accept the penalty that follows. With regard to ships and aircraft, again, if you buy or sell, capital gains arise, but now what's the provision? There's a carving out, which is making it apply only to ships or aircraft which are used in domestic operations. So if it's a ship or aircraft using international carriage, the Capital Gains Tax Act may not apply if there's a transaction. Termination benefits or compensation for loss of office. Last year, a limit of 10 million was introduced, which meant that anything above 10 million was subject to CGT, but it wasn't clear how it was to be collected. Now it has been made clear that the employer who's paying the compensation is obliged to withhold that CGT and hand it over. Stamp duty, quick one. For a few years now, each time you had a bank transfer into your account in excess of 10,000, there was a 50 naira duty to be paid. The bank charged you 50 naira. Now, it was controversial because the Stamp Duty Act did not explicitly contain this provision. It had arisen from some directive of the CBN. So it had been challenged successfully in courts, but the banks continued to charge it. Now the Stamp Duty Act has been amended to a clear codification of this levy. And so, the argument has come to an end, but it's only for receipts in excess of 10,000. Another provision
I think he's having some technical issues because he has left the meeting room, unfortunately. But I think he's trying to join again. So let's just give him one or two minutes to come back online and complete his slides before we move on to the next presentation from Mr. Olomola. So please bear with us. I think this is one of the issues with having live online events. There's nothing that we cannot manage. Okay, I think we've waited long enough, Mr. Olomola. So you can take your presentation now, and then when he comes back, he would answer questions from his side and possibly complete his presentation as well. Once again, we're really sorry for this technical failure. Okay, so.
Okay, thank you so much, Yolanda. I'm sure Theo will come back in as soon as he's able to. In the meantime, I will try to share my slides. Okay, can you please help with that? Thank you so much. So what I propose to do over the next few minutes is to, riding on the back of Theo's presentation that has gone through some of the details of the amendments to the Finance Act, to provide participants with a bit of a sneak preview into the mind of the lawman as these provisions were being considered and enunciated. And so over the next few slides, I'll provide you with some of the themes that, that served as a backdrop to the provisions that eventually made it into the legislation. On the next slide, I discuss the broad thematic areas for the legislation. As you all know, this is a continuation of the version of the legislation that was passed last year, January 13 of last year, that provided the Finance Act for 2019. The Finance Act for 2020 is themed around 5 broad areas. Firstly, in recognition of the current pandemic that's affecting global economies, to provide and enact counter-cyclical measures to enable a restart of the Nigerian economy, and also to provide a basis for crisis intervention, not only for COVID-19, but for future pandemics, where a declaration is made, a statutory declaration is made by the president or other appropriate authority as to the occurrence of a pandemic. The other aspect, of course, is also tax and fiscal responsibility. I see that Theo is back now, and I'm only just starting. So I'm thinking I should yield to allow Theo complete his thoughts, and then I can come back in. Theo, are you able to take charge and complete your thoughts? So I will go on with the other thematic areas until Yolanda comes back to us when Theo is ready. So the second area, of course, was to continue with the program for amending key tax legislation in order to support key tax reforms, and amending also areas of the Fiscal Responsibility Act for 2007, and recognizing that the current pandemic has also created crisis in several aspects of the economy, also in recognition of recent increases in the pump price of petroleum, which again takes a huge percentage of the funds available to the citizens. It was felt that there should be some fiscal relief provided for mass transit, and also to review the duties regime for the transportation sector so as to allow that sector, the transport sector, to recover a little bit more progressively from the economic distortions introduced by some of these fiscal matters. Also, the idea was to enact public procurement reforms and to institutionalize the ease of doing business reforms. In all, there were over 80 amendments made to 14 different legislation by means of the Finance Act of 2020. And Theo had tried to provide an overview, and I see he's back with us now. So Theo, it's a convenient time for me to pause and let you take over and conclude your thoughts in terms of the amendments.
Yes, okay, let me just...
So, okay, let's stop sharing for the moment so Theo can take over the sharing.
I hope you can all hear me. So I was talking about customs and excise duty. So for tractors and motor vehicles, that has come down, which means that people who had set up local industries to produce these are going to struggle and compete with imported products within the industry as well. That is good for Nigeria in the long run or not. The aviation industry, importation of aircraft, engines, spare parts, and components is now free of customs duty, just as VAT is also exempted. So that's good for the aviation industry. Imported goods are now, well, they were liable to excise duty from last year, but there was a carve out for goods which could not be produced in Nigeria. Now that exception has been removed. The FRS has been given powers to plug into your system in order to assess and collect tax. So if you're a retailer, they are now entitled to connect your computer system so that they can see the transactions on a real-time basis, which means they don't have to come at the end of the month to ask you for records and data. They can see what's going on as it happens. And then at the end of the month, they know exactly how much to expect. So if you're a large retailer, whether you're a spa, game, ShopRite, people like that, they are having to deal with this particular issue. But this is the way the rest of the world is going. AI countries to help in tax assessment. Another power that has been given to the FRS is they can demand information from banks, insurance companies, stockbrokers, or any other financial institution regarding transactions and regarding customers. Before now, there was a provision that allowed them to get this information from banks. Now this has been expanded and they can get it from anywhere. So again, be prepared to have the FRS coming to you to say that they got information from somewhere, that this is what you did, and you may have to explain. Those who operate in the free zone know that companies in the free zone are exempted from tax. But it wasn't clear whether that meant they didn't have to file returns. That was another a source of controversy. Now this has been clarified that they must file returns even though they are exempted from paying tax, but they must still file returns. Question if they have never had to pay tax. Another question that arises is whether they are also obliged to withhold tax when they're paying suppliers. So employees, do they have to withhold PAYE and remit to the state, the relevant governments, or not? Because the law exempts them from tax legislation, not just from payment of. That's the point that perhaps somebody might be able to comment on later on. That brings me to the end of my presentation. I thank you. And after Jibola has presented, we will be happy to take your questions and comments.
Can I just say, Mr. Emuwa, there are some questions that are very specific to your slide, okay. Especially with regards to. Yeah, so maybe we can take those very quickly before we address the others. For instance, one of the attendees said he or she does not understand what you mean by place of supply, but he didn't specify in what slide exactly. So if you're online,
yes.
Yeah.
Yes. There we have it. Yes. So what the law is saying is, if goods are in or imported into Nigeria, then because the VAT Act says that it is a tax on the supply of goods and services. So the supply must happen for the tax to arise. Now the question is, where has supply arisen? If the goods item is in Nigeria physically, then of course it is clear that supply was in Nigeria. If the goods have arrived at an airport or a seaport, VAT is taken at the port on arrival. Now, what happens where the goods are not in Nigeria, but you have a right to those goods? So if I'm sitting in Nigeria and I have a contract, a right to use a trademark, for example, is there VAT on the license and royalty payments or not? Those are sort of issues that arise. And this has tried to make it clear. So if the owner of that right or owner of the goods is in Nigeria, is tax resident in Nigeria, and the goods are registered in Nigeria, then it is, any transaction means that a supply in Nigeria has taken place. If the owner is not resident in Nigeria, but has given, has dealt with a right that is available in Nigeria, it may not be caught by VAT. So in many cases, the answer will be clear, but in some cases, there'll be some doubt as to whether, in fact, if the legal owner of this item is outside Nigeria, but the item is moving around or trading in Nigeria, is it taxable in Nigeria? Is there VAT or not? If a service is rendered in Nigeria by a person in Nigeria, then the supply is taking place in Nigeria. But when you look at the definition of exported service, which is also in the VAT Act, it says an exported service is a service rendered within or outside Nigeria by a person resident in Nigeria to a person outside. Yes, so an exported service is a service rendered within or outside Nigeria by a person resident in Nigeria to a person outside Nigeria. Now, exported services are exempted from VAT. So when you look at the definition of exported service, and you look at this provision, which says service rendered in Nigeria by a person in Nigeria, it seems that there's some overlap between the two. And so I can see that there'll be occasions when there'll be doubt as to whether that payment should be subject to VAT or not. So that's what I was trying to allude to here. There are areas of ambiguity which only time will tell how they get resolved. If a service is consumed by a person in Nigeria, it's clear that it's in Nigeria. Now, where a service is connected with immovable property in Nigeria, so for example, you have a building in Nigeria, a foreign engineer comes in to do evaluation, and he goes back and you pay him over there. The question is, he came in here for a day or two, goes back, sends an invoice. Should there be VAT or not? Now, this is making it clear that there should be VAT, even though he's not tax resident in Nigeria. So that's where that issue of place of supply, can be sometimes controversial. I don't know if that answers the question, but what I'm trying to say is that sometimes the answer will not be a clear yes or no, and so there'll be room for doubt one way or the other.
Thank you very much for that very detailed explanation. One final question before you go. Someone said if you could please explain again what withholding tax on non-resident companies mean. What it is.
Okay, well, when payment is made by a consumer of a service or a buyer of goods, there would usually be withholding tax. So if I provide a service to you and I send you an invoice, when you are paying me in Nigeria, you would withhold some of that payment and send it to the taxman in my name. That's withholding tax. Now, where it is between a foreign provider or supplier, service provider, and a Nigerian consumer, the question is, should there be withholding tax? First of all, is that income taxable in Nigeria? And if so, should there be withholding tax taken by the person in Nigeria who's making the payment? Because the taxman is looking for how to collect his money as early as possible. He doesn't want to wait till the end of the year when he does an assessment, to collect his tax. He's saying, if I can collect my tax when payment is being made by the two parties, then that's better for me. So in the case of a foreign service provider, before now, it appeared that if you're a foreign service provider, you may not be subject to Nigerian taxation. But that has changed. And that service provider can be subject to Nigerian taxation. The question is, how do you assess him? So what the law is now saying is that the person in Nigeria who's making the payment for the service should withhold some of that money and send to the taxman and say, well, this is, I received a service from so-and-so in Germany. His fees were, 5,000 euro. The withholding tax is, say, 10%. So here is 500 euro in the name of that, entity. And the taxman will accept that money and not ask for any further tax. So it means that the foreign entity is now paying tax in Nigeria, whereas before now, it wasn't always the case. I don't know if that's
Thank you.
Question. Yeah.
Thank you very much. I hope that it does as well. But we're already fast spent on time. So we will take the other questions after Mr. Olomola's presentation as well. So we can leave the floor open for Mr. Olomola to take over. I'm so sorry for the delay, sir.
No, not a problem at all. So I'll try to take over the screen again. Thank you so much. So I had just gone through providing clarification as to the thematic areas, the broad thematic areas for the Finance Act of 2020. and I had highlighted that there were over 80 amendments made to 14 tax laws, 14 laws, not only tax laws, there were also non-tax laws that were impacted. For example, the procurement legislation. And Theo has, over the last few minutes, gone through a read through of the most salient modifications made, but it's not proposed that in a very brief session of this nature, we would be able to go through all the 80. But if there are specific questions that are not covered in either Theo or my presentation, we'll be quite happy to take them. So moving on to the next slide, I would like to provide a bit of a background to the economic imperatives and the key drivers for the Finance Act of 2020. And on the left hand of the screen, I try to share some information about where we are. We all know that the tax to GDP ratio in Nigeria is quite low at about 5%, 5.7%, which is even lower than 6% it was at around 2012. So we're not doing well in terms of our tax to GDP ratio. In some countries, like in South Africa, for example, the tax to GDP ratio is almost 25%. In some European countries, it's as high as 30%. So at 5%, Nigeria has one of the world's 2 lowest tax to GDP ratios. What that means in a nutshell is that the finance that should be used, the money that should be used, revenue that should be used to finance the economy is not filtering through to the center because of leakages in the system. Those leakages could be from tax non-compliance to a very unwholesome tax exemption regime, which is indicated, for example, in the fact that in Nigeria today, almost every sector is asking for tax exemption. It's almost like the new mantra. Nobody wants to pay tax. But if nobody pays tax, how then do we finance the government? How does government provide services? So tax to GDP ratio is low. The inflation rate is high at about 13%, 13.7%. And interest rates are also pretty high, although in the last year, through CBN intervention, interest rates have motivated lower over time. In terms of the 2021 budget, the total revenue estimated to be generated from tax, oil, non-oil, tax and non-tax revenue is about 7.9 trillion, 8 trillion, while the total expenditure in the budget is about 13 or 14 trillion, meaning that there will be a deficit of 5.8 trillion to be filled by the managers of the economy. The Finance Act is intended to be, or at least to provide some insight into how the government intends to finance the 2020 budget. And since it was introduced in 2019, the question has been asked to if there was a consistent theme that's driving the Finance Act, or if it's, as most other things in Nigeria, as the spirit leads. What I can tell you from the work we have done in supporting the government in these activities is that there is a consistency in the logic being deployed to the enunciation of the fiscal policies that are also consistent with the MTEF, which is the medium-term expenditure framework, and the fiscal strategy paper. So there's some consistency of thought in the policy imperative that underpin this legislation. For 2020, the directive that the government sought to achieve were that there should be no new taxes, because the government felt that given the state of the economy, the productive element of the economy would not be able to withstand imposition of additional taxes. So no new taxes. By the same token, there should be no new incentives. And the tax reforms that should occur will be such as support the provision of fiscal stimulus to productive areas of the economy. And also, any tax relief that is given should be short, focused, and uncontroversial. So if you take, for example, the reduction in the minimum tax rate from 0.5 to 0.25%, it was done with a sunset provision such that the incentive will automatically expire at the end of 2021. Moving to the next slide, I then try to give a snapshot of the performance of the Finance Act of 2019. So if you look at the total tax, in 2019, the total tax budgeted was 5.2 trillion. whilst for 2020, what's expected is about 3.8 trillion, which shows a decline of about 26%. But the really interesting thing in this slide, I mean, you're going to have all these slides, so I don't need to go through them line by line. What I would like to draw your attention to in terms of how the fiscal revenues performed in 2019, 2020, is to take a view of stamp duties. In 2019, the government generated 18 billion from stamp duties, whilst in 2020, it's about 75. That's a growth of about 310%. Whilst in relation to gas income, as an alternative to oil revenue, the economy was able to grow its share of gas income by about 448% in 2020 relative to 2019. The only other area where we had a reported growth is in relation to customs service import VAT. That's the VAT that's collected by customs at the port of entry, which is calculated on the value of goods imported into the country, where there was a marginal increase of 2% in the 2020 revenue vis-a-vis 2019. The impact of the Finance Act of 2019 is yet to be fully realized. But if you recall, last week, FRS announced that it achieved 98% of its budget for non-oil tax revenue in 2020. And this is despite the fiscal buffers that were provided in the Finance Act of 2019, including reduction of rates for small and medium scale enterprises, exemption of VAT for small and medium scale enterprises, and elimination of excess dividend tax, and a few other key policy changes that were enunciated in Finance Act 2019. The immediate impact of this appear to have been a streamlining of the tax net, a strengthening of the tax net, bringing more people into the tax net, and an increase in tax yield relative to the reductions that are given away by means of the Finance Act. Notably, stamp duties revenue increased exponentially. Now, for 2020, if you go to the next, for 2020, Theo has already enunciated most of the changes here, so I propose to skip this slide, but there were changes across companies' income tax, capital gains tax, stamp duties act, VAT, and other non-tax fiscal policies. Next slide. I want to focus over the next two slides on some reforms that affect foreign companies operating in Nigeria specifically. And where Theo has commented on them, I'll just add one or two complementary points. The first one was to close the gap in relation to the significant economic presence rules, which have now also been encoded in the Personal Income Tax Act, so that for entities that are not taxable under SITA, they will be taxable under PITA, and the same rules would apply to both. For international shipping companies, in relation to their non-freight income, there is a clarification as to the taxability of such income under the general provisions of SITA and not under the provisions, the specialized section for taxation of freight income, which is limited to outbound freight income at 2%. So, but for companies, for international companies and shipping companies that come from countries that have a tax treaty with Nigeria, it is very likely that their non-freight income will continue to be bundled up and treated in the same manner as freight income. So there may be tax planning opportunities available here for operators in this sector. Furthermore, there's now tax compliance requirements for non-resident companies that have been required to file tax returns in Nigeria. But bear in mind that if that non-resident company is only receiving income that is subject to withholding tax as final tax, there will be no necessity to comply with the tax compliance requirements of the SITA. Additionally, the incentives for agric production was also clarified in the Finance Act. On the next slide, please, we speak a little bit about the reduction of levy on motor vehicle importation, and there has been quite a bit of talk around whether or not this is a reversal of government policy. I would like to view this as a review and not a reversal of government policy. The auto policy has been in place for 7 years now, and we all know that we want to help Nigeria grow and to become a bit more industrialized than we currently are. But like the Vice President also said at a seminar last year, in around December of last year, if you compare the demand for motor vehicle importation into Nigeria vis-a-vis the local capacity for production, there's a huge delta. And so the implementation of the current policy is one that potentially impoverishes the vast majority of Nigerians, and there was a need to adjust that slightly. I believe that's an entire masterclass of auto policy framework review has been enunciated and approved, or at least presented to the Federal Executive Council, and we'll be hearing more about this in subsequent days. There was also a change in the classification of aircraft for duty purposes, because the government recognized that the aviation industry is one of the most devastated industries as a result of travel restrictions brought upon by COVID-19. And that sector currently requires significant support from the government if it is to survive the pandemic. And so the Act provides some incentive to the airline industry by exempting the importation of aircraft, engines, spare parts, and components from import duties. I think the aviation sector would be quite pleased with that provision. In addition, the legislation exempts airline tickets, domestic airline tickets, from VAT. This is to cushion the effect on passengers who have been suffering high or increased airline fares as airlines struggle through the pandemic. So the idea here is to remove VAT as a line item in the way airline tickets are priced in Nigeria. If we move next slide, the other provision that potentially affects foreign companies in Nigeria is the empowerment of the Federal Inland Revenue Service to utilize information technology as a means to collect information. Now, when CEO was presenting, he went so far as to say information and collection of taxes. It's important to note that the government has not gone so far as to empower the FRS to utilize IT to collect taxes. What it has done so far is to empower them to collect data and collect information, which will enable them to determine and forecast what revenue should come in. I expect that in the near future, provisions will also be included that will empower FRS to utilize IT to collect taxes. But even ahead of those provisions, there are some sectors in Nigeria where there's convergence between the FRS objectives and the sector's imperatives. For example, Theo mentioned retailers like ShopRite and Co. that already have a framework or memorandum of understanding in place with the FRS where technology can be utilized to collect taxes. And this would ease the administration of taxes in Nigeria, which is a key World Bank indicator for the ease of doing business framework. So because FRS will now also have access to a lot more data than it previously had, courtesy of this legislation, the legislation also introduces significant penalties for any breach of data privacy or data confidentiality by tax officials. Furthermore, in recognition of the COVID-19 realities, which discourages taxpayers from going physically to a tax office in order to transact their business, there are now provisions in the legislation authorizing communication with the tax authority, including tax dispute resolution to occur by remote technology. And so it is now possible to communicate with the FRS through electronic correspondence. and to have proceedings at the tax appeal tribunal conducted virtually so that taxpayers can actively participate without being physically located. So that's that reform. And on the next slide, we also talk about reforms that affect companies operating in free trade zones, which now have to also provide data to the tax authority in the form of tax returns. And we also talk about public procurement laws modifications to those legislation, and also the submission of contract performance guarantees by means of an insurance bond as an alternative to a bank guarantee. That again, because insurance bonds are easier to procure than bank guarantees, that potentially reduces the burden on government contractors to provide surety to a bank for the provision of a formal bank guarantee. So these are the highlights of the matters that served as a backdrop to the enunciation of this year's Finance Act. The continuation of government policy with respect to this Finance Act should encourage Nigerian taxpayers to engage proactively with the government through the FRS and the Ministry of Finance and any other sector or group in order to ensure that future finance acts are promulgated in a manner that's consistent with the expectation of the taxpayers. There are still a few housekeeping areas that must be taken care of in future tax legislation. It is hoped that through the instrumentality of the Finance Act and the 2021 and 2022 versions that are being anticipated, some of these areas will be taken care of. So I come to the end of my slides, and I will be very happy, together with Theo, to address some of the questions that have come up.
Thank you very much, Mr. Olomola, for that wonderful presentation. Just to confirm if Mr. Emuwa is still with us and can hear us before I proceed with reading the questions.
Yes, I can hear you. Can you hear me?
Yes, we can. Fantastic.
Okay.
So just to also say that some of the questions have not been addressed to either of the speakers, so feel free to answer at will, and if you want to maybe put some additional information into a speaker's response, please feel free to do that as well. So I will just start with the first question, which came in much earlier. It says, can you please confirm through the amendments to the Finance Act 2020, which amended the VAT Act, was the concept of significant economic presence removed? So
well, I'm happy to take that, and Theo, please indicate if you would also like to comment, but I'm happy to take that. No, the concept of significant economic presence was not removed. If anything, it was enhanced by enunciating similar provisions in the Personal Income Tax Act. It's important to take note that significant economic presence is not a VAT provision, it's an income tax provision. It's a means which is adopted also by OECD for determining the contribution that multinational corporations and companies that operate, large multinationals that operate across borders, the contributions they should make to the local economies where they derive value from. So it's an income tax provision that is enunciated in the Companies Income Tax Act, and by means of the Finance Act of 2020 has also now been documented in the Personal Income Tax Act.
Thank you very much for clarifying that. Another question,
Yeah,
yes.
Well, Yolanda, maybe I can just add one more point.
Yes,
there.
please.
I think maybe the person asking the question is thinking about VAT chargeable on services, inbound services by foreign entities, which was an issue that was controversial and went to court. That has the position taken by the courts has been recognized by legislation, and so if a foreign entity is generating income in Nigeria, it will have to put VAT on its invoice, but the entity in Nigeria is the one to hold back the VAT and remit to the taxman. So if they're looking, if the person thinks that has changed, that has not changed. In fact, it's now clear that you can't escape that.
Okay, thank you for that addition, Mr. Emuwa. Okay, if there's no further comments, I will move on to the next question. This is from Moses, and is asking if the decision to exempt those receiving salary below the minimum wage based on data, what is the volume of tax lost to the state? Either of you can take that.
Jibola, I leave you to answer that.
Okay, thank you. In fact, prior to the legislation being adopted, I'm aware that at the National Assembly, there was a lot of discussion around this, and also at the National Economic Council, which is where the states also sit. And when they were reviewing the Finance Act proposals, a number of the states were quite concerned, legitimately so, that enunciating a tax exemption for persons at the minimum wage level might erode the tax base for many of the states. And the models that I saw indicated that that would be the case. If you think about it, for many states, not many states have adopted the minimum wage. There are some states that are still paying, that are using wages or paying wages that are below minimum wage. So the impact of that exemption cannot be understated. But at the same time, it was necessary for I think it's a welcome move by the government to provide this exemption, because it recognizes that people at the very lowest income levels or income bands in Nigeria, they need a lot of support if they're going to survive. And so it's the least we can do to at least recognize their special circumstance and place no further burden on them to contribute towards tax, as was previously the case where they had the minimum tax provision that they all had to comply with. So the impact on the states is potentially high, but there's some talk around what the states can do, particularly in the area of fiscal federalism, to augment their own internally generated revenue and mitigate the impact of this exemption.
Thank you very much. Mr. Emuwa, do you want to add anything else, or I can move on to the next question? Okay, maybe I'll just move on because I'm trying to be fast because of the time. There's a question here from Julius asking if foreign individual he said, can the foreign individual contract out of the SCP withholding tax? If that question is clear.
Okay, I'll start with that and Theo can comment if he wishes. But I guess the questioner is approaching this from the perspective of withholding tax generally, where in some contracts that I've seen, the contract amounts are grossed up, and so technically the responsibility to account for Nigerian tax is passed on to the Nigerian client. But if you bear in mind that the Finance Act of 2019 already had provisions that will now disallow anyone that pays tax on behalf of anyone else from getting a deduction for that tax. So the answer to your question is yes, from a legal perspective, the Supreme Court has recognized that so long as the tax is paid, you can contract the duty to pay the tax out. But from a tax perspective, if that duty is then taken on by the Nigerian service recipient, which means that the contract fee is grossed up to include taxation. Under those circumstances, even though it will be legal, that tax that is borne by the Nigerian client will not be tax deductible in the hands of the Nigerian client. That would be a disincentive to, at least an economic disincentive to the Nigerian client in agreeing to take on that burden.
Okay.
Sorry, Yolanda, I missed that question. I got my system tripped again. I just wanted to hear what the question was.
Which one? The one that Mr. Olomola just answered?
Exactly, yes, yes.
Okay, let me quickly try to find it.
Yeah.
So the question was whether an individual can contract out of the SCP withholding tax on SCP provisions. And my answer was that the Supreme Court in the Adegboyega case had already ruled that withholding tax, that tax can be, contracts can be grossed up, and the responsibility for paying tax can be contractually assigned. But the Finance Act of 2019 has now made to be an unauthorized deduction any tax borne on behalf of anybody else. So even if to agree to those gross up provisions, which under the law it could do, the Nigerian client would not be able to take the economic benefit of that decision because he will not be able to get a tax deduction. So that will be a disincentive to agreeing to contract out of the SCP provisions.
Yeah, okay, no, I agree entirely, Jibola. I just wanted to say something about the point you were making before about states losing money because of the minimum tax provisions. Now, that is true, but what government has done is the stamp duty which is being collected for the the 15 naira from on bank transfers, there's a sharing formula, and the states are to share 85% of that. So I suppose what government has done is to say, okay, we'll give you something more on the other side. So maybe at the end of the day, states might actually do better, because as Jibola has shown, the stamp duty number went up by what, 300. So if states are getting 85% of that, what they lose on PIT for income workers may be less than what they make up. And in fact, I think the stamp duty number will continue to go up every year because it's transaction based. So I think just one side of the picture. There's a bigger picture, and tax is about not just collecting money from you, but about encouraging economic activity or discouraging certain types of activity. So if government is saying, okay, let's help the people at the low, right at the bottom by not, placing a bigger burden on them, most of them will not pay this 15 naira bank transfer, because 10,000 2 times in a month, that's more than their salary. So they are unlikely to suffer this 15 naira. But those who will suffer the 15 naira, those who are earning more. So in terms of progressive taxation, the money is taken from those who have and is being given to those who don't have, or who have less.
Absolutely. But then the fiscal federalism conversation will have to continue, because if you think of the stamp duties on electronic transactions, that platform is provided by corporate entities, banks, which are regulated under the exclusive legislative list and not the concurrent legislative list. So you are soon going to have a discussion about what the sharing formula for stamp duty should be. Should it be 85% to the states and 50% to the federal, where the federal is the entity that is actually bearing and providing the cost for the collection of that stamp duty revenue in the first place? But like I said in my discussion, that fiscal federalism conversation will continue, but ultimately that is the way to support the state governments that will be losing revenue.
Thank you to the both of you for that exchange. Since Mr. Emuwa was already on, there was a question directly to him, which I wanted to continue from. It still goes back to the question on place of supply. It says, are there any protections for a taxpayer where the place of supply is Nigeria and the same goods are taxable in other jurisdictions? Or maybe Mr. Olomola, you could come in as well, in case we have lost him.
Well, ordinarily, I mean, many countries use different rules for determining which jurisdiction should charge VAT. And most countries adopt similar rules as Nigeria has now adopted for place of supply. So generally, if you were to purchase goods in, say, the UK that are marked for delivery to an address in Nigeria, even if you were to suffer the VAT in the UK, you will be entitled to a VAT refund at the port once you can establish that the good is not being consumed in the UK, but is going to a foreign destination. So it's unlikely that you will have a situation where VAT is charged in multiple jurisdictions on the same item in the manner that the question anticipates. But where that should occur, bear in mind that the Nigerian VAT is very much like a sales tax. So on importation of goods, for example, it is the customs authorities that will administer the VAT at the port of entry. And their only interest is to take the total value of the goods as shown in your bill of lading, the import duty on it, and all the other matters, add that up and charge you the VAT on that. So they are not very concerned with whether you have paid VAT in another country or the other. But I think there are protocols available internationally to try to mitigate the occurrence of the kind of risk that you have described.
Okay, so maybe since we're still on VAT, maybe to take these questions at the same time. It says, does VAT exemption cover tickets of foreign airlines bought in Nigeria? And also, is VAT payable on purchase of OML?
Okay, so for foreign airlines, I'm aware that currently you will not see a VAT charge on airline tickets for international travel. So I'm not quite sure whether the basis for that is very clear. However, as of today, when you look at the components or the breakdown of the price of your airline ticket, you will not see VAT there for international travel. Now, in relation to OML, again, it depends on what exactly is constituted in that OML. Is it the deposits, the proven deposits that's being sold? Is it the assets that have been placed on top of the OML to exploit the mining deposits? Is that what is being sold? So you have to look at the components of sale and then look at the VAT law and the way the VAT applies to the components. So for example, if the component is a rig that is movable, maybe you put a rig on top of that OML that's movable, that's potentially chargeable to VAT. But if the component is the proven reserves, which have not yet been lifted, that will be part of the land that's comprised in the OML, and the VAT, the Finance Act of 2020, has specifically exempted VAT on land. So anything that constitutes land will be exempted from VAT. However, if there are movable goods or things that can be separated out that are not constituted as land in the disposal of that mining interest, then those matters could potentially be vatable. And I'll refer you also to the decision of the Federal High Court in the Sapetrol case that deals with the applicability of VAT on disposal of mining interests. So the Federal High Court has already clarified what the VAT rules should be in that respect. Thank you.
Thank you.
Jibola, if I can just add to that, Jibola, thank you for that. But I will point out that if what you're selling is the interests, in the license, that is incorporeal property, and the amendments to the VAT Act now capture that. So in fact, the government's view is that the oil in the ground is not yours to sell until it comes out of the ground. So what you have is a right to explore, which is just a license right, and that is in the Sapetrol case that which was one that we were involved in on behalf of the taxpayer. The VAT Act had not been amended, so that was the argument we used, that this is a supply of something intangible, and the VAT Act does not contemplate it, and that is why the amendment of 2019 has now changed that. So if they did the same transaction today, to escape VAT.
So it would again, so we have to go back to the componentization of what was actually disposed of. Are you disposing of the land? Are you disposing of the license? What exactly are you selling? So once you determine what that is, then the VAT law can then be applied to that.
Correct. I mean, the most valuable aspect in most cases will be the license, actually. But you're right. You allocate it accordingly. Yeah. And another point I wanted to make, going back to what legal.
Sorry, so you still have to have that position on whether an OML, because it's an oil mining lease, not an oil mining license.
Contractual right.
So is the OML, does it meet the requirements of the law for a lease? Because a lease is a conveyance of estate, in which case the lease would be a lease of land and landed property, as opposed to a license to just explore. So the oil exploration license, the OEL, is a license, but the OML is a lease. So one has to be very careful to understand exactly what bundle of rights does the OML holder have, and what exactly is being disposed of.
Yeah, correct. I mean, without going into too much detail, I think the OML, it is a lease, but it's a lease that gives you more than just a right to occupy the land. It gives you a right to go underground, because it says the oil on the ground belongs to the government. So that's the starting point. But they say, okay, we'll give you a lease, which is a right for 20 years to be on that land, go into that ground, bring it out the oil, and then, you know, the oil is only yours when you bring it out. While it's still on the ground, it's not yours. That is the theory, shall we say, you know, which, like you say, needs to be tested. Yeah. And another point I wanted to bring up regarding the states losing money because of is that when you look at who's paying most of these, the 15 naira bank charges, it'll be the states where the cities where you have a lot of commercial activity. So Abuja, Port Harcourt, Lagos is where most of that money will come from. But it's being shared.
Kaduna, yes.
But it's being shared amongst the 36 states. So many states will probably get more from this than they would have gotten from their, you know, PAYE that, you know, they're losing. That's what I suspect.
Yes, you're right. And so you find that states like Lagos are already protesting.
Yes, exactly.
I mean, that the formula is not fair to them.
Exactly.
Because essentially you are taking revenue that should come to Lagos State, and you are sharing that with states like Bayelsa, states like Akwa Ibom, where there's very little banking activities going on. So they don't think that it should be just a matter of taking the 85% and sharing it among the states. They would like to see some reference to derivation. So you fed derivation to determine what state should get what. Now, if you were to use derivation, then many states will be disenfranchised.
Yeah, so that's another issue. So many states would actually do better with this, but the big states you have mentioned would do worse.
Yes.
Okay, thank you so much. We are really running out of time already, so I would just quickly take a few more questions. We still have a lot of questions though to address. One of the questions here says, please, in respect of withholding tax by Nigerian for services by foreign person, is there a recourse for such foreign entities, e.g. DTAs?
The answer is yes. So the provisions of the double tax agreement, the DTAs, will continue to apply to income that is covered under those provisions. Yes.
Okay, great. Okay, there's a question here which says, will the African Free Trade Agreement have any impact on goods and services deployed from outside Nigeria for Nigerian entities or consumers in comparison to non-ACTFA services, that is from the EU or other regions?
I believe so, although Theo is probably better placed to answer that question if he's back. Okay, but yes, the provisions of the Africa Free Trade Zone Agreement is, it will override local legislation by being supranational in orientation. But Theo, your views?
Yeah, so is the question about will the African Free Trade Agreement have an impact on goods and services deployed from outside Nigeria? Is that the question?
Yes, yes.
Okay. Or in comparison to in other words, will the goods coming from within the continent be cheaper than goods coming from outside?
I would like to think so. If the person who asked the question is still around, you can just comment in the chat box.
So if that is the question, the answer is yes. The idea is goods from within the continent should have an advantage from outside.
Okay, so there's a question here that says, do tax...
But there are conditions. So, and those conditions, there are conditions for you to be able to access the AFCA benefits. The goods must be truly African. So it's not just about importing first into a country and then distributing across Africa. There are some requirements that will actually have those goods be African in production for them to qualify. But that's probably a much more deeper conversation that's going to be had around the AFCA.
Yeah.
Okay, maybe we can take these two questions, the two questions that just came in. One says, what do you see as the likely implications of the Finance Act 2020 on taxpayer data policy, specifically on MNEs with operations in Nigeria who are covered by the GDPR?
Okay, the GDPR is in relation to MNEs, multinational entities, and it's typically a tool of transfer pricing. And what you find is that if you look at the company's income tax legislation, there are no detailed provisions legislation itself around transfer pricing. You find that those regulations are in the transfer pricing regulation that has been issued by the FRS. So the provisions in the Finance Act are supposed to give comfort to entities that are complying with the transfer regulations and other regulations around provision of data to give them comfort as to the confidentiality with which those information will be kept and maintained. So it's consistent. You remember also that we have the automatic exchange of information protocols, which most banks are also having to comply with now. So by means of all these tools, the tax authorities of Nigeria and other countries are going to have access to a lot of information than they previously had. And there need to be rules around the protection of that data.
Okay.
We also have the Nigerian data protection regulations, which are similar in some cases to the GDPR, which as well.
Okay, so maybe we can take this one last very long question, still with relation to the SCP provisions on withholding tax. He said, how do you reconcile the SCP provisions with withholding tax in CETA? Are you saying that if withholding tax on services is paid, it is the same as VAT invoiced by foreign companies, which is then withheld by the Nigerian entity and then remitted? And to be clear, it is this withholding tax that ensures that the foreign company doesn't need to subsequently file annual returns. Is it this? Yeah. And the question is going to both speakers, so maybe we can split it.
Okay,
you've got to distinguish between income tax and VAT.
Exactly.
They are two completely separate legislation, and the trigger for income tax is not necessarily the same as the trigger for VAT. So for VAT is a simple question of whether you've supplied goods and services. For income tax, you need to go into consideration of whether you have a fixed base, whether you have a significant economic presence. So, I mean, and if you don't have those things, even if you supplied services and goods and you've earned income in Nigeria, you will not be taxable. So the tax base is completely different. Withholding tax is an advance on income tax. So for you to be taxable and subject to withholding tax, you must have a liability to income tax in Nigeria. That withholding tax, so let's say you're entitled to 100 Naira and your withholding tax is 10%. So instead of getting 100 Naira from your Nigerian client, you will get 90. So that's a diminution of your income. VAT, on the other hand, is not the tax on the service provider. It is the tax on the consumer. So let's say again, you supplied goods worth 100 Naira to a Nigerian recipient. You don't pay the VAT. It is the Nigerian recipient that should pay that VAT. So at 7.5%, instead of paying 100 Naira to you or 90 Naira once withholding tax is deducted, the Nigerian recipient has to pay an additional 7.5. So the VAT is not your tax in those circumstances. You are just a means by which the government collects the tax from the taxpayer. So the two must not, they must be kept separate at all times. They don't relate to each other.
Oh, okay, Mr. Emuwa, do you want to say anything else on that, or we can move on? Or probably lost him again. Okay, I think this will be the last question before we end the session. It says, how do we remit the SCP withholding tax deduction or non-resident company to FIRS? Do we get in on behalf of NRC, or how will we process the run? How will the process run?
That's exactly what you have to do. You've got to obtain a tax identification number for the party on whose behalf you are deducting the tax, and then remit to the FIRS in that name. There are regulations that have been issued by the FIRS on how to make this process work, and you can familiarize yourselves with those regulations. You can download them from the website of the FIRS, and you can familiarize yourself with them, or you can speak to your tax consultants, including ourselves and Aelex, and have them walk you through what you've got to do in order to be able to comply.
Yeah, if you can just add, there's actually a dedicated office now in the FIRS, the non-resident taxpayers unit, which is at our road. They do this kind of issue. So the FIRS recognized that they needed to have one place where everybody who's asking these questions goes to and submits the form and all that. Another thing to that, as in foreign entity, the tax laws allow you to appoint an agent. So what you do, or it make it easier, is to appoint a local person as your agent to interface with the FIRS, and that way the FIRS, the payments and collection of receipts can then be facilitated. So yes, it's a straightforward matter, but the answer is you have to comply.
Thank you. Thank you very much. I think that we've taken enough questions for the day because we are already far beyond the time, but you could reach out to me directly, and if you maybe need more clarification on one or two of the items that have been discussed, I will be happy to put you in touch with either or both of the speakers from today. I can share their I think they've both given me the permission to share their contact information with you. So if need be, please reach out to me and I'll be happy to provide you with that information. I just want to also say a very big thank you to our speakers from today. This has been very, very interactive, interesting, and also very knowledgeable. Thank you for taking out the time to be here. We really appreciate, and we hope that we can continue this conversation much later, maybe privately. Do you want to say one or two things to those who are still online before I end the session?
Well, I'd just like to thank you, Yolanda and Theo, and also to all our participants and to the delegation, the German delegation, for providing us the opportunity and the platform through which to speak to the assemblage of distinguished personalities on this call. Thank you very much.
Thank you so much. I think that Mr. Emuwa also has gone against bad network, but I also want to say thank you on his behalf. And I've answered a few of the questions. We'll make the slides available as well as the recording from this presentation on our website or our YouTube channel. So please stay tuned for information on how to access that. And so yes, with this, we've come to the end of this session. Like I said initially, my name is Yolanda Oguma, and I'm the head of events and marketing at the delegation. And I hope you will join us very soon for another interesting session on more topics during the course of the year. So yes, thank you, and do have a great day. Bye-bye.